Joining us right now is Saira Malik, who is Chief Investment Officer and Head of Equities and Fixed Income at Nuveen. Saira, I take it that you were listening to what the Treasury Secretary had to say. What do you think coming out of that interview?
Well, markets are skeptical that the use of tariffs to rebalance global trade won't lead to either a growth scare or a reacceleration of inflation. And that's why you've seen the S&P 500 gains since the election get completely wiped out, and also international markets are outperforming the U.S. markets year to date. I think the catalyst that we need to see for the S&P to find solid footing is either clearer signs that economic data is strengthening, and that will either come from the consumer or employment markets. Now, from the consumer, we've seen retail sales miss. We've seen companies talking about how the consumer is pulling back. And then looking at employment markets after January's number, which was fairly weak versus the prior months, and also the fact that half of payroll creation since 2019 has been government driven, I'm concerned today's payroll number will be closer to 100,000 rather than 200,000, and that we're going to see continued signs that the employment market is weakening. So I think this trend of the U.S. remaining defensive and European and Asian markets outperforming the U.S. is likely to continue for the time being until we get that economic clarity.
So you don't sound like you're a buyer right now of U.S. equities.
I think it's tough for U.S. equities because of the economic data that we're seeing and the fears over inflation. Now, I get the argument that deregulation and tax cuts could lead to offsetting any issues we see because of tariffs, but those are further out right now. We don't have clarity on those. And then, of course, there is this question about the Fed. Usually when tariffs come into place, you do see a one-time bump in inflation. Will the Fed look at that as transitory, or will the Fed react to that is unclear. So all of that uncertainty in the U.S. and the fact that we came into this year with the S&P 500 at about a 20% premium to history makes it tough. And let's not forget one more thing, which is the technology sector. 30% of the S&P 500 weighting, tech stocks have suffered, and that also is leading to the U.S. suffering versus the rest of the world.
Yeah, I guess in terms of inflation, in terms of the pain that the president has acknowledged, there could be some short-term pain in some of these issues. I think the question becomes how long and how deep in terms of that pain. Have you tried to put any of that into your figuring here?
Well, I think that's, what's unclear right now. If you look at market technicals, they're quite weak. Earnings growth for the first quarter was up about 12% year over year. So we have seen strong earnings, but the outlooks are pretty murky at this point. And then I did mention technology stocks. I think that's another real issue for the economy and the markets. We did see Broadcom report a positive number, which is good, but I think that's very Broadcom specific because of their custom chips and also their non-AI business. But if you look at tech overall, Marvell, NVIDIA, we're seeing weakness there. And I think it's going to be challenging for the U.S. to outperform when 30% of the S&P's benchmark is around a sector that's struggling. I think there's earnings downside. There's unfortunately some valuation compression issues for the U.S. that could be ahead of us. So until we see either that consumer start to reaccelerate and come back more strongly, or employment markets not show signs of initial cracking, it's going to be tough to find the bottom for the U.S. markets.
6 weeks ago, all you heard from executives, corporate executives, was this idea of animal spirits. Today, when you talk to them, most of them will cite uncertainty as the biggest factor that they're kind of focused on right now. And you might be able to pin that back to the tariffs, the on-again, off-again nature of these things, the uncertainty with what's going to happen. Would you change your mind if there was more certainty on the tariffs, if we knew exactly what the playbook looked like, or if we said, never mind, we're not going to impose some of those?
I think definitely markets would appreciate more certainty here around tariffs, and also maybe some clarity from the Fed in terms of how they may react to tariffs. But of course, the Fed may not know that yet until we see start some of the impact from the tariffs that are coming into place. If you go back to the election, the optimism around the election was around the tax cuts and how that would help the consumer, and deregulation theoretically opening up the M&A market. Unfortunately for the markets, we haven't seen that yet, but what we have seen is this back and forth and this roller coaster ride with tariffs. The back and forth on tariffs is creating uncertainty, and of course the impact of those. Does the consumer bear the cost? Does the producer bear the cost? How does the Fed react? All of that is becoming very unclear for the market to price in, and that's why you're seeing so much volatility. The S&P generally moving at least 1% a day over the past 6 or 7 days. All of that is the market's telling you they don't really know which way to go given this lack of clarity. So clarity would definitely help here, and I don't think we're getting that at this point.